Marcus saved for 30 years. He did everything right. He maxed his 401k, he diversified, he stayed in the market through 2 crashes, and in January 2000, at 62 years old, he retired with $1.2 million and a plan to withdraw $50,000 a year. Right around 4%, just like every retirement calculator told him to. By the end of 2002, he had lost nearly half of it. He was not the victim of bad investing. He was not reckless. He did not panic sell. He was the victim of something that almost no retirement calculator accounts for. Something that can take a mathematically sound retirement plan and quietly destroy it in 3 years without a single bad decision on your part. It is called the sequence of returns problem. And if you are within 10 years of retirement or already in it, this is the most important concept you will encounter all year. Here's what most people get wrong about retirement planning. They think the math is simple. Save enough. Earn a decent average return. Withdraw at a safe rate. Done. And honestly, during the accumulation phase, the math is that simple. When you are putting money in every month, volatility is your friend. A down market means you are buying shares cheaper. But the moment you flip from saving to spending, the entire logic inverts. And that inversion is not obvious. It does not show up in savings calculators. It is a structural flaw in how most people model retirement. And it has nothing to do with which stocks you picked and everything to do with when the bad years happen to arrive. Let me show you exactly what that means with numbers. Imagine a $1 million portfolio loses 20% in its first year. You're down to $800,000. Then you withdraw $50,000 for living expenses. Now you are at $750,000. To get back to $1 million, you do not need a 20% gain. You need a gain of more than 33%. And you are making that climb on a smaller base every single month because you are still paying your bills. The shares you sold to cover expenses are gone. They cannot participate in the recovery. The damage is permanent and asymmetric in a way that accumulation math never has to account for. That is the mechanism. Now let me show you the full picture. Imagine 2 investors, Marcus and Priya. Both retire on the same day with $1 million. Both earn the exact same average annual return of 7% over 20 years. Both withdraw $50,000 per year. On paper, their outcomes should be identical. Marcus retires into a bad sequence. His first 3 years produce returns of negative 23%, negative 13%, and negative 11%, roughly what the S&P 500 delivered from 2000 to 2002. His later years are strong, producing the gains that average everything back to 7% over the full period. Priya retires into the mirror image. Her first 3 years are strong. Her difficult years come later when her portfolio is larger and her withdrawals represent a much smaller percentage of the total. Simulations of return sequences like these routinely produce dramatically different outcomes. In many cases, the retiree who experiences heavy losses in the first few years can exhaust their portfolio a decade or more before the retiree who experiences those same losses later, even though both average identical returns over their lifetime. Same starting balance, same withdrawal rate, same average return. The only variable is the order in which the returns arrived. This is why sequence risk is not a performance problem. It is a timing problem, and it is almost invisible until it is too late. William Bengen first quantified this in a landmark 1994 paper in the Journal of Financial Planning. He was trying to answer a deceptively simple question. How much can a retiree withdraw annually without running out of money over 30 years? He analyzed historical market data going back to 1926 and found that the specific sequence of early returns was the dominant variable in whether a retirement survived, not the long-run average. His analysis produced what became the 4% rule. A retiree withdrawing 4% annually from a diversified portfolio had historically never depleted their savings over any 30-year window in his dataset. But here is what most people leave out when they cite that rule. The 4% rule survived even the worst historical sequences in Bengen's dataset, but those results were built on a specific historical period and carry no guarantee for future retirees. The hardest cases were retirees who began in 1966 and 2000, years that opened with poor returns and sustained inflation. Many of those retirees had to reduce withdrawals mid-retirement just to keep the plan alive. The rule is a historical observation, not a promise. So what do you actually do about this? There are 3 strategies that financially prepared retirees use, and none of them are complicated. They just require thinking about retirement differently than most people do. The first is a cash buffer, not a savings account sitting on the side. a structured liquidity bucket you build before you retire and draw from deliberately during down markets. Research from financial planner Michael Kitces suggests holding 1 to 2 years of living expenses in cash or short-term instruments at the point of retirement. The logic is direct. When markets fall, you spend from the cash bucket instead of selling equities at a loss. You give the market room to recover without permanently shrinking your equity position. One important thing to understand: a cash buffer does not prevent losses in your portfolio. It simply gives you an alternative source of spending so you're not forced to lock in those losses by selling. That distinction matters. You are not eliminating risk, you are decoupling your monthly survival from the market's worst moments. The second strategy is called a bond tent. The name sounds dry, but the concept is specific and useful. A bond tent means gradually increasing your allocation to bonds during the years leading up to retirement, and then slowly reducing that allocation afterward as the highest risk window passes. The idea, developed by researchers Wade Pfau and Michael Kitces, is to build a shield of lower volatility assets around your retirement date, the period of maximum sequence risk exposure, and then let that shield dissolve as your equity position stabilizes. This is not about being a conservative investor. A bond tent is a time-specific hedge, not a permanent posture. If you are 45, this is not relevant yet. If you are 58, this conversation with your financial advisor should already be happening. The third strategy is flexible withdrawal. This is the one with the most direct impact on whether a retirement survives a bad sequence, and it is the one most people resist because it feels like giving something up. Most people treat their withdrawal rate as a fixed number, $50,000 a year, no matter what the market does. But a fixed withdrawal in a falling market forces you to sell more shares to raise the same dollar amount. Because each share is worth less, you're accelerating the damage at exactly the wrong time. Research from Vanguard's 2020 paper on dynamic spending found that retirees willing to reduce spending by even 10 to 15% during a sustained downturn significantly improve the long-run survival of their portfolios. You are not gutting your lifestyle. You are removing the rigidity that forces asset sales at the worst possible prices. This is exactly where Marcus's plan broke down, and it is the part most people miss. It was not just that the market fell, it was that he kept withdrawing $50,000 a year on a fixed schedule all the way through it. Every month, at the market's worst prices, he was selling shares that could never come back. After 2002, his portfolio had been cut nearly in half, and he still had decades of expenses ahead of him. The math did not fail him because his investments were bad. It failed him because a rigid withdrawal rate turned temporary market losses into permanent ones. Priya did 3 things differently. She held 18 months of cash going into retirement. She had gradually reduced her equity allocation in the 3 years before she retired, building her bond tent, and then shifted back toward equities over the following 5 years as her cash buffer absorbed the early volatility. And when the dot-com crash hit, she cut her withdrawal by 12% for 2 years, drawing from cash reserves instead of her equity position. By 2003, when the recovery began, her portfolio was largely intact. She participated fully in the rebound. Her retirement not only survived, it grew. Here is the reframe that most retirement content will never give you. The financial industry puts enormous effort into optimizing your accumulation phase. Save more, invest earlier, compound longer. All of that advice is correct and worth following, but it treats your retirement date as the finish line when it is actually the starting line of the most financially exposed decade of your life. Researchers have called the period surrounding your retirement date the retirement red zone, roughly the 5 years before and the first few years after. Work published in the Journal of Financial Planning found that negative returns during this specific window carry a disproportionate and often irreversible impact on retirement outcomes, far greater than equivalent losses at any other point in the retirement period. The same crash that would be a manageable setback at year 15 becomes a structural crisis at year 2, because year 2 does not give you time to recover before the withdrawals compound the damage. You spent 30 years building a portfolio. The 4% rule, diversified allocation, compounding. All of it is real and it matters, but none of it insulates you from sequence risk if you walk into retirement with a rigid withdrawal rate, no liquidity buffer, and full equity exposure on day 1. Average returns are a useful planning tool. They exist in spreadsheets and calculators, and they are worth understanding. But real markets deliver returns in a specific order, on a specific timeline, and that order, not the average, determines whether your retirement works. If this changed how you think about the years ahead of you, subscribe. We cover the mechanics underneath the numbers every week.